present value considers all the sources of finance, meaning that in a capital investment project, you have to consider where you source for the fund, whether it is equity, debt, or under debt, whether it is cheap loan or subsidized loan from the government. In a project finance, in calculating the adjusted present value, you need two items: the base case NPV and the PV of financing effects. The question is, what is base case NPV? The base case NPV is the normal NPV that consider the relevant cash flow. But what you will use to discount the base case NPV is the cost of equity of the ungeared company. Meaning that it is assumed that the project will be financed by equity. Of course, it is an assumption. And that is what takes us to Modigliani and Miller, M&M, assumption theory, that says that business will be financed only by equity. Even in Nigeria today, the top companies, right, they are not only financed by equity, they are financed by equity and debt. A practical illustration where we have July 2022, July 22nd of July 2025, according to RIPS Nigeria, they said Ohando want to convert their debt to equity. Is an example of a convertible debt. Debt to equity. If both party agrees, but not an obligation. Meaning that it is not only equity that is being financed a company, including debt. So it is an assumption that this project will be financed only by equity. That is the reason why you need to use the cost of equity of the ungeared company to discount the project. However, how do we now calculate the cost of equity of the ungeared company? There are two approaches. The first one is to use the usual method to identify the proxy company, determine the assets beta, that is ungeared. The next step is to use the assets beta to determine the cost of equity. That is the cost of equity of the ungeared company. The beta assets will become your equity beta. Or alternatively, we can make use of Modigliani and Miller Preposition 2, which assume no tax, which assume that the project will only be financed by equity. Of course, it's an assumption. I will send the note immediately after this class. Modigliani and Miller assumption under the dividend policy, as well as method of financing. The cost of equity of the geared company equals to the cost of equity of the ungeared company. This is what we are looking for. Minus the cost of debt of the proxy company, the value of debt of the proxy company, the value of equity of the proxy company, the tax rate of the proxy company.
So
whereby you need to make KE the subject of the formula. The KEU, the subject of the formula, because that is what you want to get. You want to calculate. Maybe X. Definitely the cost of equity of the geared company will be given to you in the question. You look for these variables as well in the question. Then you just say, let S represent the cost of equity of the ungeared company. Right? So there are two approaches to determine the cost of equity of the ungeared company to be used to discount the base case NPV. When you check the first approach, you look at it that can you get the variables? If you can get it, use it and move on. If you can't get it, quickly switch. You can switch to Modigliani and Miller, preposition 2, and make KEU the subject of the formula. Having explained this, we need to move to the next one, which is the PV of financing effect. Now, this is when the sources of finance will come to play, where we have to include the sources of finance. How do we finance a project? Under the theory of the method of selecting or the method of financing a project, we have what we call the static order, the pecking order, and the market timing. A company can use these three methods to finance a project. I will send the notes. Under the static order states that the company will look at their optimum level of gearing, meaning that before you finance a project, before you say you want to source for a loan to finance a project, you need to consider the optimal level of gearing, meaning that you need to check, is your gearing above 50% or below 50%? If it is above 50%, meaning that you have to incur more cost in borrowing, because I can see when I calculate, maybe you want to borrow money in the bank, even if the basis points is 30%, I will make it 40% because there is tendency that you may not pay back because of the high level of gearing, meaning that it will not increase the cost of borrowing. So when a company wants to finance a project, you need to look at what we call the static order, where you look at what we call the optimal level of gearing. Then in financing a project, companies should also look at what we call the pecking order theory, meaning that how to finance a project will be arranged according to their scale of preference. Now, you want to finance a project, you need to check from your retained earning. Right? Thank you. You need to check from your retained earning. When you look at it from your retained earning, you want to finance a project of 100,000 and you have a retained earning of 300,000. Can you finance that project? Can your retained earning finance that project? No. You move to another scale of preference. What is another scale of preference? Is the debt, because the cost of debt is lower. Then you need to look at it that, oh, can you borrow money to finance these projects? If you look at it that, oh, the cost of borrowing this fund is high, oh, you can switch to equity. So under the pecking order theory, you can decide to finance a project through your retained earning, right? Then the debts, right? The third one is equity, maybe by issuing shares, right? Of course, you know that when you use equity to finance a project, of course, the cost of equity will be higher than the what? Than the cost of debt. Another thing is the method of financing a project. It is what we call market timing. A company could or may look at what is happening in the market to do what? To raise funds. Class, a company may take advantage of what is happening in the market to raise funds. A typical example is when there is CBN recapitalization, where recently we have the UBA right issue, right? Right issue means that they will give you shares below the market price. Now, as an existing shareholders, maybe you have a share in the company, so they will issue a share to you below the market price. Now, as an existing shareholder, you can decide to do what we call, you can decide to do nothing. You can decide to re-announce your share. You can decide to sell your shares. It depends on what you want to do. That will take us to the sources of finance, right? If time permits us, right? Now, my point here is, as a company, you look at what is happening in the market to raise funds. That is why you see UBA going to the market to raise capital through right issue. So to make use of the market information, market timing, class. So these are the financing, the method of financing. So adjusted present value considers the all sources of finance. Now, in this case, when you want to determine the PV of financing effect, please, you use the commercial rates, right? You use the word, you use the commercial rate, or that is the pre-tax cost of debt of the main company. The question is, what is commercial rates? If you check the 27.5% of the monetary policy rate as at today, interest rates, the bank may be lending at 30% basis points because they want to make profit, or 32 basis points. Now, lending at that rate, it is what we call commercial rates. That is what we call commercial rates. So when you want to discount your PV of financing effect, you use the commercial rate to discount, right? Or the pre-tax cost of debt of the main company. Or in some literature, they will tell you to use what? The borrowing rate, right? The borrowing what? Rate, which is commercial what? Commercial rate. Now, these are the items you need to know under the PV in calculating the PV of financing effect. Issue costs of equity, class. The question is, what is issue costs, class? A company want to finance a project, right? Maybe the cost of the project is 50,000, class. If the cost of the project is 50,000, how much will it now cost the company to raise the 50,000 naira? It is what we call issue cost. The right issue of the UBA bank, maybe they want to raise 500,000 for instance. the cost that we cause them, what we cause them to raise that right issue is what we call issue costs. And this issue cost will be added to the original amount. We will get there. That will give us what we call the gross amount. We will get there. But I want you all to understand that issue cost is like additional cost in borrowing a fund, right? What we cost them, right? In that, what we cost the company, right? In addition to what they want to raise is what we call issue cost. On equity and debt, we assume to be year zero. Now, the tax savings, it is assumed that at issue cost, you know, when you want to start a project, you need to raise money. When you raise funds, the following year you start operation, or the following month you start operation. So it is assumed that issue cost, the tax savings on issue cost will be at year one, because that is when you start what? Making money. That is when you start what? The operation, right? Now, the tax savings on issue cost, in the question, you need to look at it in the question. If the examiner says that the tax savings, it is allowed, there is tax allowable on debt, then you know that, oh, issue cost. They say, oh, tax allowable on issue cost on debt, meaning that you have the tax savings on issue cost, which is debt. But in a situation whereby the examiner is silent, so you can assume that there is tax savings on issue cost on debt. So you can state it in your assumption after your what? After your calculation, right? So after that, you have what we call the tax savings on interest costs. Class, it is, you know, we don't have interest under equity. We have interest under debt. Now, what will be the tax savings on interest costs on debt? Class, now you borrow 50,000, right? You borrow 50,000 as the total gross. Now, in this 50,000, you have to pay interest. And what is the interest? 5%. 5% of that 50,000, you will now charge tax savings. And that is why we say tax savings on interest cost on debt. Right? Now, which year will you use? It's based on the question. Now, if they say the tax is being paid in arrears, meaning that year one will be paid in year two. Maybe the project is for 5 years, so you can have 2 to 5. We'll get there. Right? Now, what is savings on interest? Class, what is savings on what? What is savings on what? On interest. Let's say, for instance, you have cheap loan or the subsidized loan from the government to be 5%. Or, no, let me don't use 5%, 5 basis points. Let me use the basis, the word, the language that they use. Let's say it's 5 basis points. Let's say the commercial rate is 20%, right? And the subsidized loan from the government is 5% below, or 5 basis points below the 20% basis point of the commercial rate, meaning that the subsidized loan will be 15 basis points, while the commercial rate will be 20 basis points, because it is 5% below the commercial rate. Now, what did you save? What is the interest saved between the two? You have 20% of commercial, you have 15% of subsidized. Of course, you will go to subsidized. How much did you save? That is the difference between the commercial and the what? And the subsidized, right? That is 5%. That is savings on interest. Where did you save it? Is on the cheap what? On the cheap loan. We will get there, right? That is savings. How much did you save? Tax paid, of course. You are saving. It will become an inflow to you. You have to pay tax on that. That is tax save. tax paid on what? On interest saved. Then you calculate your PV or financing effect. After that, you add and subtract. Then you get or you calculate what we call the adjusted present. Imagine you are just looking for two items. So we need to go through this base case NPV and the PV of financing effect. So class, before we look at an illustration to this, so do you have anyone that have question? If you have question, quickly unmute your mic. So I can attend to it before we start. Question, please. Okay. Okay. Illustration 1. So immediately after this class, you should be able to solve a question on adjusted present value. So you can check past question under the adjusted present. I think this question and the past question, they are similar. So you can check. Then at the end of this class, you should be able to solve adjusted present value. So please, who will read?
Can I read? Yes, can I read?
Yes, please.
Okay. Required. You are required to estimate the APV of the proposed project.
Thank you. Now, APV of the proposed, immediately you read the requirement and you see APV. The first thing that should come to your mind is base case NPV and the PV of financing effect. The next thing you should ask yourself is the base case NPV. Okay, I need to discount. Oh, if I have to discount, what will I use to discount? Is the cost of equity of the ungeared company. Then you look for the cost of equity first. Look for that cost of equity of the ungeared company. Calculate it first. Then after that, you will now consider the relevant cash flow in line with the normal NPV. After that, you move to the PV of what? Of financing effect. Please go ahead.
Okay. PH is a well-diversified risk-seeking PLC. It has target debt to asset ratio, that is debt over equity plus debt of 25%, and equity beta of 2.25, and a pre-tax cost of debt of 5%.
Thank you. Now, PH is a well-diversified risk-seeking PLC. It has target debt to asset. That is another language. I think I used that language in what is it called? In project specific cost of capital. That is sometimes they may tell you that it is debt to asset, maybe debt over equity or debt divided by equity plus debt, right? Can you see? This is the level of gearing of the main company of PH, which has 25%, meaning that the value of debt will be 25%. Class, value of equity will be what? If value of debt is 25%, value of equity will be what, class?
75%.
75%.
Thank you. 75%. I think someone said 100%. Away. Try. So 25%. Can you see debt divided by equity plus debt? Right? Now, equity beta of 2.25% and the pre-tax cost of debts of 5%, meaning that the cost of borrowing of the main company is 5%. The company is considering the purchase of a new machine. Class, the company is considering what? The purchase of a what? Of a new machine. Costing 600 million. Class, this is the cost of the machine, which would enable it to diversify into a new line of business. This machine will enable PH to diversify into a new line of a business. You can see the reason why you need to determine the cost of equity of the ungeared, of the policy, because this will make them to do what? To diversify into another line of a what? Another line of a business. The machine would have 3-year life, meaning that the lifespan of the machine they will have 3 years, after which it would have no residual value. The residual value will be nil. The machine would generate estimated before tax net cash inflow of 260 million a year, meaning that 1 year 260 million, second year 260 million, third year 260 million net cash flows. The suppliers of the machine is willing to lend PH of the capital at a rate of 5%. Class, please pay attention to this part. So you can see we are done with this part, right? Now, is considering buying a new machine. And that machine will generate 260 million a year. Is that also 260 million a year? So the supplier of the machine is willing to lend half of the capital at a rate of 3%. Class, meaning that they will lend you, don't worry, we'll give you half. Say you are looking for 600 million. We'll give you half of 600 million. Half of 600 is what? 300. Is that also, class?
Yes, sir.
300. And we will give you at a rate of 3%. Class, we will give you at a rate of 3%. You see, we'll give you at what? At a rate of 3%. Don't worry, we'll give you that loan. We'll give you money to finance this project. The cost of the new machine, half of it, 300. At what? At 3%. And we should not equally forget that the commercial rate of borrowing, right? The commercial rate is 5%. That the cost of borrowing from the bank, right? From the bank is 5%. This is the cost of borrowing. And then they are now saying that we'll give you, don't worry, we'll give you half of 650, half of 600. So we have 300. They will now lend you at what? We'll lend you at what? At 3%. Class. Can you see? So this is what we call a cheap loan or subsidized loan, because this is 3% and the cost of borrowing is 5%. In another case scenario, you may even have this part highlighted as government subsidy, right? As government subsidy to subsidize the what? Maybe 5% and below this. Can you see? This is what we call a cheap loan, right? The company would have we now save 5% minus 3%. They will save 2% if they can get half of it they can get half of it here. So remaining 300. So what will now happen to the remaining 300? So we can read further. The remainder will be financed equally by debt and equity class. So the balance now, class, will now be financed by both debts and equity. So you will now share the 300 into two. 150 for debt, 150 for equity. Class. 150 for debt, 150 for what? Equity. Now, the issue costs on the commercial debts will be 1%. Class, if they will give you this at 3%, half of it, remaining 300, then you will now source for the remaining 300 outside from people, debts, maybe from the markets, from commercial rates, from the markets, 150. Then you now issue equity. Maybe you do a right issue. Class. Then the issue cost. Now the cost of it that will cost the company to do that is 1% for the debt, meaning that if you borrow 500, you have to add 1% to it, because that will be the gross amount that we will borrow. Because that will be the gross amount that we borrow. You borrow 50,000. It will not cost them, for them to get that 50,000, it will cost them 1% of it. If you add that 1% to that amount, will give you the gross amount. Well, let me mute your mic. Then, and the equity we incur cost of 3%. At the same time, the cost of the right issue, because where you will get that fund under equity is right issue, is 3%. All issue costs are on the gross amount raised for the respective capital. You see this language, just leave it. What I normally tell professional students, that whether it is on the net amount, whether it is on the gross amount, just leave it. You just understand what you want to do first before you interpret this part. We'll get there. A firm that is already in the trade of the new project, can you see the Proxy company? This is part now is talking about the sources of finance that we will use in our financing effort. The next part, the next line is talking about a firm that is already in the trade of the new project has a gearing ratio, debt to asset only, 20%. Meaning that the market value of debt will be 20, while the market value will be what? Market value of equity will be 100. And the cost of equity, can you see it? They've given us the cost of equity of the geared company and the cost of equity, can you see, of 18.1%. its corporate debt is risk-free. Class. Meaning that the cost of borrowing, class, it means that the cost of borrowing of the project company is risk-free. It's assumed to be risk-free though, yes. Because, meaning that when you see risk-free, your risk-free will be the cost of borrowing of the project company. Its corporate debt is risk-free, meaning that your risk-free, if your risk-free is 10%, the cost of debt of the project company is 10%. A government grant of 10%, of the initial capital costs of the machine is available. Government will give them a grant because we don't know how important is the project to the economy. As a result of this, government will now say, we don't have subsidized loan that we want to give the company. But what we will do is that we'll give you a grant of 10% of the initial capital cost of the machine. And what is the initial cost of the machine? 600. Now, what will be the 10%? Will be the government grant. And this government grant, it will become an inflow to them because they gave them money, it becomes an inflow. It is estimated that the grant will be received at the beginning of year 2. If something is received at the beginning of year 2, it means that it is at the end of year 1. They will receive it at the end of year 1. They will get it at the end of year 1. Let me use that language. They will get it at the end of year 1, right? From the government. Plus, they said it is estimated that the grant will be received at the beginning, meaning that it is at the end of year 1, because that will be the beginning of year 2. The tax rate is 10%, payable 1 year in arrears. The tax is being paid in arrears. Straight line, depreciation on the net costs after deducting the grant is tax allowable. So we need to do a tax savings here. The straight line will be the capital allowance because it is tax allowable. Then you will not charge tax savings. But it is after. You will not include, when you want to charge it, when you want to do a tax savings, you will not, you have to deduct the cost or the grants from the costs so that you will have net. That net, you will now do your depreciation. Then that depreciation is allowable. That meaning that it is capital allowance. Then you do your what? Your tax savings. We'll get there. So the risk-free is 4% and the market return is 7%. So we should not forget this. Its corporate debt is risk-free. So now the risk-free given to us is 4%. So definitely the corporate debt, the cost of borrowing of the project company is 4%. Don't forget this part is talking about the Prosy company. Prosy company. You are required, prepared, adjusted or estimates adjusted present value. Suggested solution. Suggested solution. What is the name of the company? PH. Now, before we start, we should not forget, we need 2 items. The base case NPV, which is the normal NPV, and the PV of financing effects. But we will use the cost of equity of the ungeared company to discount the projects. So we need to sort that one out first. Class. So we need to calculate the costs of equity of the ungeared company, which is the Prosy company. Class. Whichever approach we want to adopt, we can do that. Is it, I will do approach 2, right? Using the Modigliani and Miller, you can try the first approach. You will still arrive at the same answer. So, using the Modigliani and Miller, proposition 2, which assume that a project or a company will be financed only by equity. So if a company is being financed by equity, there's no tax. That is proposition 2, is an assumption. Right? Is an assumption. If you check the notes, so stated that no, this thing will not happen. No, we just said it is just an assumption. No, right? It's just that we may assume it, but in real life situation, it may not be applicable. It is stated. It is just an assumption. Now, what will be our cost of equity of the geared company? We need to go straight to where we have information about the Prosy company. You just go straight to the point where you have information about the Prosy company. A firm that is already in the trade of the new project has a gearing ratio of 20%. Market value of debt is 20. Then the market value of equity is 100. And the cost of equity class. This is the cost of equity of the geared company. It is an assumption. Don't forget. So this is where you will check if you are given the cost of equity of the Prosy company. You use it. So we will have 18.1. Please mute your mic. Please mute your mic. We will have 18.1. Then, don't forget that this is what we want to calculate. We want to calculate the cost of equity of the ungeared. So you can say let S represent the cost of equity, let's S represent the cost of equity of the let's X represent the cost of equity of the ungeared company. So this will be the X class. So we will have this. Then the market value of debt. That will give us the level of gearing. And what is the level of gearing? Debt to assets. Debt divided by assets equals to 20%, 20, right? So meaning that your value of debt is 20, then the value of equity, where is the value of equity? Oh, that's fine. The value of equity, VE, I can use this to be value, I can change this to be value of debt. Value of debt, value of debts of the POSI company. This will be value of equity of the POSI company. To be 100 class. We are picking all this information from the POSI company class. This is what we have here. The next is to pick the cost of debt of the POSI company. We're told that its corporate debts is risk-free. So meaning that the cost of debt of the POSI company will be risk-free. Class, and what is our risk-free here? Class, what is risk-free?
4%.
4%. Thank you. So this will be 4%. 4. You can use 4. So what will be the tax rates for the POSI company? Is it given? The tax rate of the POSI company, they just gave us only one tax rate. So it is assumed that the tax rate will be for both the POSI company and the main company. So 20%. So we can come down here. How many percent? 20%, right?
30.
30%. Thank you. So we can come here. The cost of equity of the ungeared company, based on the assumption, is 18.1. The cost of equity of the ungeared company is X. The cost of equity of the ungeared company is X. The cost of debt of the POSI company is 4. The market value of debt of the POSI company is 20. The market's value of equity is 100. The tax rate 0.3, right? 0.3, 0.3, okay. .3. I can have here 18.1
Sorry, sir.
is
Sorry, sir.
equals to, I'm still doing something now. When I'm done, please.
Okay, it's because the market value
I'm
of that
still
equity of
doing something. The level of gearing is debt to assets. The market value of debt is 20. Then the market value of equity is 100. Based on the formula, the debt is 20. Then the market value of equity is 100. So we can have x plus x minus 4. What do we have here? Just give me the final figure here. 20 divided by times, what do you have here?
0.2.
0.2. Is that the final answer that you have here? 20 divided by this times 1 minus
Okay, that's
0.3.
0.14.
0.14.
Mm.
Right. 0.14. Please confirm. 0.14 is equals,
0.14 is correct. Is correct.
thank you, is equals to x. You use this to open the brackets. So we can have 0.14x minus 0.14 times x times 4. What do you have?
0.56.
0.56. Right, 0.56. 18.1 is equals to this plus this. We can have 1.014x minus 0.556. So therefore, 18.1 is equals to or minus or plus 0.56 equals to 1.014x.
Sir, is that supposed to be 1.014, 1.14?
Yes, sir. It's supposed to be 1.014.
1.0, which this side?
No, this
No.
1.014 is supposed to be 1.14.
Yes.
1 point, okay. Thank you. So when you add these two together, what do you have? We add these two together.
18.66.
18.66.
66.
18.66. You can mute your mic. Is that 1.14x? When you divide both sides by 1.14x, our x equals to what?
16.37.
What do we have?
16.37.
16.37
0.37.
will be the cost of equity of the ungeared company, or 16% will be the cost of equity of the ungeared company class. Of the ungeared company, if you use the second approach, you should have 16.3 or 16% class. A firm that is already in the trade of the new project has a gearing of this, and the cost of equity of 18.1. This will be your cost of equity of the geared company, will be the cost of equity of the closing company given to you in the question. It's an assumption, right? So meaning that your debt and your equity will be equals to 18.1, and that is why we have it here to be 18.1. So before I proceed to the calculation of the base case NPV, right? So if we have anyone that have question, you can quickly unmute your mic. So
Good evening, sir.
good evening.
Yeah, thank you, sir. So I'm having issue on that our debt to equity ratio. He said
So what is the
20%
issue?
debt to assets. So if
Okay.
20% debt, then I think the equity should be 80% because assets make up of both debt and equity.
Okay, that's fine. That's fine. Did you start project specific cost of capital with us?
Yes, I did, sir.
But I explained something like this. Yes. When we have debt to assets, it means debt to equity. If we have it in this format, it means debt, market value of debt is 100. Then the market value of equity, market value of debt is 20. Then the market value of equity is 100. But in a situation whereby it is like this, that is where you cannot apply what you just said. In this part now, debt will be 25. Equity will be 75 because it is written in this form, in this format. Debt over equity plus debt. But when you have it like this, the denominator should be 100%. So it is assumed that it includes both your assets, both your asset and your what and your equity. So the denominator will always be what? 100. Thank you. Have I answered your question?
Yes, sir.
Thank you. Any other question, please? Okay. Thank you. Now, we need to move to the calculation of the
Sir, we
base
have
case.
not copied this one that you did. We've not copied it, sir.
You can do that later now. It's on YouTube, madam. So should I wait for you to copy it?
No, you said we will sit down. You said while we are here, it's just as you are talking, we'll sit down and be writing. That's why.
Okay. Okay. Madam Victoria.
Yes, good evening, sir. Yes, I don't know how you got 1.14 because I've been doing it here. I'm getting 0.14.
1.14. This is
1.14,
one.
yes.
This is one. This X is one. This
Okay.
is 0.14x. This X here is one.
Okay.
You have it with this. You have this.
All right. Thank you, sir.
Thank you. Now, The base case MPV, or we need to do some workings now. Is that not so? Let's start from the net cash flow. We're told that the machine would generate estimated before tax net cash inflow of 260 in a year, right? And the project or the life of the machine is just for 3 years. Is that not so, class? It's just for what? It's for 3 years, right? Oh, wow, makes sense. So cash flow. How much is the next cash flow, class? Net cash flow?
260. 260.
260. Please, a minute. A minute, please. Thank you. Okay. 260 a year, and the machine is for 3 years. 1 to 3, right? Then we have, don't forget that the base case MPV is our normal usual way of calculating MPV, except the PV of financing effects, where we need to consider all sources of finance. What is the cost of the machine? Cost
600.
of machine is equals to 600. Right? Then, which other thing we need to consider for our base case?
Tax saving.
Okay, the tax savings. Let's check again. The government grant, right? The government what? The government grant. So we need to check, and we're told that how many percent? Yes. Let me plug my system.
10%. 10%.
Thank you. 10%. Yeah. Sorry, please. Let me confirm. Okay, yes, actually. Thank you. So the cost of machine is 600. Then the government grant is 10%. All right. So 10% of 600. What do we have? What do we have, class?
60. 60.
60. Which other thing we need to consider, class? The tax savings, right? Can you see we've considered this, right, as a net cash inflows? Then the government grants to be 10%, and it will be received at the beginning of year 2. At the beginning of year 2 means that it will be at the end of year 1. Then the tax is being paid in arrears, straight line depreciation on the net cost of the machine. After deducting the grant, is tax allowable. That depreciation is allowable, is capital allowance. So therefore, determination of tax savings is on straight line method. What is the cost of the machine? Oh, they said after deduction. Is that not so? So let's do it this way. Let's do it this way. Cost of machine is equals to 600 million. Then government grant 60. What do we have? What is the net cost?
540.
What is 540? 540 net cost. 540. So straight line 540 minus residual value. Do we have residual value in this question? I think the residual value is nil. The residual value is nil, which have no residual value. Can you see it? Nil. Class. This is normal MPV, but this is on straight line method. Divided by
Above, yes.
the numbers of years is tax allowable, meaning that what you get here is your capital. What you will calculate here is your capital allowance. When you have this, what do you have? When you divide this, what do you have?
103.
Divided by 3. Thank you. What do we have here?
180.
180.
180. Then we need to move tax savings. So what you calculate here is tax allowable. That is your capital allowance. Class. This is your what? Capital allowance, because it is allowable. Then tax savings. What is the tax? How many percent is the tax?
30%.
30%.
30% of 180. What do we have?
564.
64, right?
54.
54. And tax is being paid in arrears. Year 1 will be paid in year 2. Year 2 will be paid in year 3. Year 3 will be paid in year 4. Therefore, this side will now be 2 to what, class? 2 to 4. Is that not so, class?
2 to 4.
2 to 4, because tax is being paid in arrears. So, determination of base case MPV.
And we didn't do the tax paid. We did the tax savings.
Tax paid. Oh, don't worry, we'll do it. I understand. Right, we'll do it. Okay. I get. So we can. Should we do it like this? Okay, let's just do it here. Don't worry. Year 1, year items, the cash flow, the DCF will be the costs of equity of the ungeared company class. The PV, right? So the initial cost of the machine, oh, yes, 0. Machine, right? 600. Right? Okay, let's do not MMMO. This is So we have 600. This will be 600. Next, we have the cash flow. Net cash flow. Don't forget it's before tax. What is the net cash flow?
540.
260. 260. You have to check your annuity table, or we have to use annuity formula to get our DCF. What is our DCF? Do we still remember annuity formula?
2.246.
2.246.
Okay. Do we have anyone who is in this class? Like, and you don't understand how to determine or how to calculate annuity? You can make use of the annuity table. At the back of your question paper, you will see annuity table there. Just check 1 to 3 and check the numbers of years. So we have this
2.246.
2.246. When you multiply this, what do you have?
583.96.
583.96. Of course, you have to pay tax. You have to pay tax on your cash flow, on your cash inflow.
Size 93, not 96.
93. You have to pay tax. Class, you have to pay tax.
It's 96.
You have to pay tax on this. Is that not so? And tax is being paid in arrears. Year 1 will be paid in year 2. So you have 2 to 4 tax paid. The tax is how many percent? 30%. So what is the 30% of your net cash flow?
$78.
78. 78. So, okay. Now, when you want to determine the DCF for 2 to 4, first, determine 1 to 4 using the annuity formula. Please, what is the DCF from year 1 to 4?
2.798.
From year 1 to 4, I'm coming.
2.798.
0.16. 0.16. raised to power 3 raised to power 3. This will be from year 1 to year 4. Okay. Should I present it this way? Year 1 to 4, year 1 to 4, year 1 to 4. Okay, let me bring it down. Right. You have year 1 to 4. What do you have?
2.798.
This will be raised to power 4, sorry, because it
Yeah.
is from year 1 to 4. What do we have here?
2.798.
798.
98. Yes.
2.798 plus. If you do from year 1 to 4, what did we need? We only need the one of year 2 to 4. Is that not so? Class. Is that not so? So you need to determine year 1. If you remove year 1, you will have 2 to 4. So you need to do your year 1 using the normal DCF. 1 divided by 1 plus R raised to power of n. The raised to power of n will be 1. Right? So when you do it, what do you have for 1 year?
0.862.
0.862.
862.
So when you remove 1 year from this, you can have year 2 to 4. What do you have?
1.936.
1.936 will be your DCF from year 2 to 4. So therefore, we can have 1.936. So when you multiply, what do you have?
151.008.
151.008. Thank you. The next we have the government grant at year 1.
Hello, sir.
We have, I'm coming, sir. We have the government grant, okay, I'm listening. Go ahead, please. Go ahead. Please go ahead.
Okay, sir. Please, that 78 tax paid at 30%. How did you get this minus 78, sir?
Okay, sir, you will just calculate. Do you know what you do? Okay, let me, don't worry. You understand it now. Come. So you have this, you just say 30 divided by 100, sir, times 260. Sir, if you do it this way, you will have 78. Sir, are you with me?
Yes, sir. Yes, I'm with you, sir.
Do you get it now?
Yes, sir.
Any other?
Okay, I've gotten it. I've gotten it.
Any other one? Any other thing? Like, you're good now,
No,
right?
sir. No. Yes, sir.
Thank you. Now, government grants. The question says is at the beginning of year. At the beginning of, where is it, sir? Government grant. Okay, at the beginning of year 2. At the beginning of year 2 means at the end of year 1. at the beginning of year 2, definitely you would have received it at the end of year 1 for it to begin at the beginning of year 2 class. So that is why the year you have 1. So the government grant will be an inflow. What is the government grant? 60 million, 60. So what is the DCF?
0.862.
So when you multiply this, what do you have?
51.72.
51.72.
51.72. So we can have tax savings. Our tax savings is from year 2 to 4. Tax savings 54, right? 1.936. We have it already. Please, when you multiply, what do you have?
104.54.
100 and what?
104.54.
104.5.
104 point what?
54.
54.
54. So what do we have? We are done with, I think we don't have any other information we need to, yes. So what would be the best case? What would be the best case MPV? What would be the base case?
Minus 10.778.
Okay, minus 10.78 negative. That is the base case MPV. So what next? We need to determine the PV or financing effect. Before I proceed to the PV or financing effect, please, if you have questions, you can unmute your mic quickly. Please. Please remember the steps. You need to calculate the cost of equity of the ungeared company. Then you determine the base case MPV, your normal MPV, but the only thing you will use to discount is the PV of financing effects, meaning that it is assumed that the project will be financed. The base case MPV will be financed by what? Only by equity. Class. Now, the next, what we have next
Sorry, sir.
is
That base case should be 10.79.
10.78, 10.79. Well, no, it's still one naira. Is that not so? 10.79 or 10.78. That's fine. The PV of financing effects. Class, if you dey sleep, I beg, wake up. You can chewing gum, and I can buy gum for you if you want to. If you want, I can just
But
do.
when they sleep, will not go hear you.
I beg. You see this at this point here, right? I beg, no sleep. Oh. Yes, please, because this part is it is as important as anything. Please. So we can take water. Let's take water. You can take water. So the PV of financing effect, consider the sources of finance. We should not forget that from our analysis, from this part here, this paragraph is talking about how the projects will be financed. So we need to arrange it accordingly before you calculate your PV or financing effects. We need to arrange the sources of finance, class. So please pay attention. Now, I will write here sources of finance. Sources of finance class. What is the costs? Costs. Oh, where is this thing now? BB. Okay. The costs of the machine. Please, can you see my screen? Can you see it clearly, please? Can you see it clearly?
Yes, we can.
Okay, that's fine. The cost of the machine is 600. Let me bold it. Yeah. Let me bold it. It's 600. Right? The cost of the machine is what? 600 million. How do we now finance this machine? Where are we going to source for this fund? Right? That is the question. Class. From our table, from our formats here, we have issue costs. Is that not so, class? But before we get to this issue costs, let's analyze how we source for the finance. Now, the supplier of the machine is willing to lend PH of the capital at a rate of 3%. Don't forget that PH can go to the market, can go to the bank and collect loan for 5%. That is the commercial rate. But the supplier is saying that, okay, we will give you half to be 3%, which is half of the machine. So you can see that this 3% is lower, right? Compared to what? 5%. So you can consider these sources, this source, as a cheap loan. As a cheap what? As a cheap loan. It is below the commercial rate of 5%. We can consider it as what? As cheap loan class. Half of this. We can have cheap loan. Oh. Cheap loan. Right? Half of it. Half of 600 million divided by 2. What do we have? 300 million. What would be the rate? The rate is 3%, class. The rate is 3%. Please, the process or the steps in calculating adjusted present value does not, even if you see a question, you can apply this step. It does not change. It is still the same thing. Now, if we have this here to be cheap loan, why this is the interest rate? Why others will be what? The remainder will be financed equally by debt and equity. Out of 600, they will borrow you 300. The remaining 300 will now be financed by equity and debt. So this cheap loan is debt, right? You can agree with me that this is debt. Now, or let me say, okay, let me just put it like that, John. Debt, right? It will work out like this. Okay, yes. Okay, now you can have debt, right? Coming commercial debts. Don't forget, it will be financed equally, the balance by debt. And what is that debt? It is commercial. If you can get cheap loan to be this, and they say the balance will be financed by debt and equity. What is that debt? It's commercial. You go to the bank and borrow that balance. The balance is 300 divided by 2 equally. We have 150. The question is, what is the commercial rate, class?
5%.
Thank you. The commercial rate is 5%. The commercial rate is what? The commercial rate is 5%, class. Now, you will have the commercial rate to be 5%. Then the equity. Don't forget, it will be financed equally by debt and equity. 150. Of course, equity, you in right issue, you don't have any interest. Is that not so? Equity does not have interest, class. Equity does not have interest. So this is how 600 of the cost of machine will be financed, class. This is how it will be what? It will be financed. Now, from our formula, from our format, let's start. From our format, we have issue costs. Step 1. Step 1. Is this thing showing this thing now? Step 1. Step 1. Class, are you there?
Yes, sir.
Determination of issue cost. Please, no sleep, oh, I beg. So we'll finish this question. Class, issue costs. From our question, what did they talk about issue costs? They mentioned something about issue costs. And what is it? The issue cost on commercial debt will be 1%. And the equity issue will be what? Will be 3%. You want to borrow 50,000. Before you can borrow it, what are the costs you will incur? It is issue costs. You need to add that issue cost to what you want to borrow so that it will give you the gross amount. Class. The first one is what? Debt, right? Hello, class.
So, yes, sir.
My people, they sleep.
Commercial debt.
Child.
Commercial loan.
Commercial
Yeah.
debt. Yeah. No, yes. We did. Please, you can chewing gum, right? So you can tell me, just send me your bill. Yes. So, commercial what? Commercial debts. Now, how much did you want to raise? That is, what will be the net amount on commercial debt is 150. Class, is that not so, class? Class,
Yes.
Yes.
150. Now, this 150.
Yes, sir.
Thank you. This 150 million is the net amount. The net amount. We need to remove the issue costs from this 150. So it is 150 million. Then issue costs. Issue cost. How many percent is the issue cost in the question?
1%.
1%.
1%. So you need to gross it up. If it is 1%, it will be 1 divided by 99. Please mute your mic. 1%. It will be 1 divided by 99 times 150 million.
1.52.
1.52. Class, you need to gross it up. That is why you have to, because we want to remove the element of issue cost from that debt, because that debt includes the issue costs. If it is 2%, it will be 98. 2/98, class. So when you add it, what do you have? This will give us the gross amount. What do you have?
151.52.
151.52. Class. This is how to determine issue costs. Right? This is how to determine, or let me remove this. Yes, just change it like this. So this is how to determine the issue costs. You will borrow this, you have to add the processing costs, and this will give 151.52. Class, the next issue cost we need to have here is the issue cost on equity. is the issue cost on equity? Equity, wait. Equity, right? So how much did you want to borrow from equity? 150, right?
150.
150. You can see, what did you notice? You notice that cheap loan did not have issue cost because it's very cheap. You won't incur any cost. It is very cheap, right? So in some question, they may give you that each cheap loan, the subsidized loan have issue cost. Fine. But in this question, we don't have such, right? So we have 150. What is the issue cost?
3%.
3%. That is what? 3 divided by what, class? 97, right?
Yes.
Yes.
97 times 150. What do we have?
4.64.
4.64.
4.64. So what would be the gross amount?
154.64.
The gross amount. Oh. The gross amount. I don't know why this is. I'm coming just in minutes. Okay. The gross amount is what? What is the gross amount?
154.64.
154.64. Class. The issue cost is at year 0. Year 0. We should not forget this. Based on the format, the issue cost is at what? At year 0. From our format, step 2. Class, step 2. Tax savings on issue costs. Tax savings on issue costs. I said something that if the question is silent about the tax savings on issue cost, it wasn't mentioned here that they're supposed to say, after this, they're supposed to say tax savings on issue costs. There is tax savings on issue costs. But it wasn't mentioned. If it is not mentioned, you can assume that the tax savings on issue costs is on debt class, because it is not what? It was not mentioned in the what? In the question. You state your assumption. Step 2. But sometimes you may have tax savings on issue cost on debt and equity if it is stated in the question. Class, are we still together? So, tax savings.
Sorry, sir. You said if it's stated in the question, if it's not stated in the question, we should assume we are doing it, or I don't get that
on
part
debt.
again, sir.
On debt. We are doing it on debt. That is what we want to do now.
Okay.
Because it wasn't stated in the question that the question is even silent about tax savings on issue costs. So you can, it is assumed that the tax savings will be on debt, on issue cost on debt.
Okay.
Because,
Okay.
yes.
Okay. Thank you, sir.
You're welcome. Tax savings on issue costs on debt. What is the issue costs? Issue costs on debt. What is the issue cost on debt? 1.152, right?
1.52.
1.52 times, what is the tax savings? What is the tax given to us in this question? How many percent? 30%, right?
30%.
30%. So what do we have here?
0.456.
0.456. Class. It is assumed that when you borrowed this class, or when you borrow this amount, you will now start your operation. It's just like initial investment at year 0. Immediately after that, you commence your operation, you have year 1. So this can be claimable in year 1. So we can have here year 1. Step 3. What do we have in our format? Step 3. What do we have? Class. Class. Are we sleeping?
Yeah.
Hello. Are we still together? Okay, that's fine. That's fine. We have tax savings on interest costs. 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 Class. Where are you going to claim your tax savings on interest? Who can tell me, where will you now claim your tax savings on interest? On interest. Where will you claim it? Which of the sources of finance? Class.
The cheap loan.
The cheap loan and commercial. Class. The cheap loan and commercial. That is where you have tax savings on interest costs. Class is where you have interest is commercial and cheap. That is why it is interest. So we can have cheap loan. How much do they want to borrow under the cheap loan? What do we have here?
300 million.
300 times, what is the interest? 3%.
3%.
That is the interest times the savings. Class. The savings What is the savings? The tax is 30%. So what do we have?
2.7.
0.7.
2.7. Then we go back to, don't forget that cheap loan did not have issue costs. Then we now have commercial debts. Which of these commercial debts are we going to use? Should we use this 150 or the gross amount class?
The gross amount.
Gross
The
amount.
gross amount. Thank you. Because the gross amount include the cost of borrowing. So we have to include the interest. Because cheap loan did not have, we did not consider it. But if cheap loan has, we can consider it as well. We can check for the gross. So, interesting. Commercial debt is 151.2. And guess what? For the past 3 to 4 diets, I can use it to test question on adjusted present value. Do you know, are you thinking what I'm thinking? The decision tree that came out last diet, I can tell you for like 6 diet to 7 diets, no decision tree. Most people are forgotten, like, you even forget that decision tree even exists. Then it came out last diet. The same thing applicable to portfolio theory. If you check 3 diets or 4 diets now, you can't see a question on portfolio theory. Are you thinking what I'm thinking? Bond valuation. I can test question. Oh, this thing is strange. Okay. No, we'll continue the discussion later. Oh. 151.52 times what is the interest? What is the interest on commercial? 5% times 30%. What do we have?
2.27.
Okay, I'm coming. Two point what?
2.27.
2.27. But Mukuna no sleep. Oh. So addition of these two will give us the tax
4.97.
savings. Okay, what do we have?
4.97.
4.97. 4.97. Step 4. Step 4. Let me put it here. Gross amount.
Hello, sir.
I'm with you.
Sir, I want to confirm this. Cheap loan and subsidized loan, they are the same thing,
They are
sir.
the same. Yes, sir.
Thank you, sir.
Thank you. Thank you. That makes sense, right? Makes sense. They are the same. So in some question, you have cheap loan, you have subsidized by the government. So they're the same. Thank you. So Next, what do we have? What is the next step? Savings on interest, right? Class, are we still together? Are we tired?
Yes, sir. Yeah, yes, sir.
No, we're not together, sir.
Okay. Savings on interest. Savings step 4. Savings on interest. Class, you have cheap loan to be 3%. You have commercial debt to be 5%. How much did you save? How much did you save, class?
2%.
2%.
2%. Right? You save 2%. Class, are we still together, please?
Yes, sir.
You save 2% because you go for cheap loan. 5% minus 3%. You save 2%. 2% of what did you save, class? You say you save 2% of what, class? 2% of what?
300
300 million.
300. Thank you. You save it. You decide to go for cheap loan. You run subsidized loan. Right? Subsidized what? Loan. So we have 300. 300. So what do we have? Oh, I didn't put the numbers of years, sorry. The tax savings on issue costs. Tax is being paid in arrears. It will be from 2 to 4. Because tax is being paid in arrears. It is only the issue cost that is assumed to be year 1. After that, you have to apply the tax savings based on what the question says, because the question says what tax is being paid in arrears. So what do we have here?
6 million.
6 million. Right? We have 6 million. Savings on interest. So you can see that this part is not tax savings, so it is just savings. You save it. If you are saving it, you will pay tax on what you are saving. Is that not so, class? So this savings here, it means that you will save 6 million year 1. You will save 6 million year 2. You will save 6 million to year 3. So year 1 to 3. That is what you will save. Because this is tax savings. That is why we have 2 to 4. But this is just savings. The last step, please, in our next class, you will tell me these steps. So from step 1 to step 5. Step 5. Step 5. What is step 5, class? Tax paid on interest saved. interest saved. Adjusted present value is if you will understand it if you have someone that really understand SFM. You will understand adjusted present value because you need to just follow the step. We have so many people that are even good in SFM. They are good in SFM. They can take adjusted present even when they are asleep, they can take adjusted present value because they understand this step. And when you see a question, it is still applicable. That is the good thing about it. You can still apply it. So you save tax paid. Of course, you have to pay tax on the 6 million. How many percent? 30%. What do you have?
0.8.
What do you have?
0.8.
1.8. It is tax 2 to 4. Please take notes. Yes. So we are done with the step class. So we can put all these things in the table.
Hello, sir.
Right?
Sir, I have a question,
Adjusted present value.
I know. Sorry, sir. I have a question, sir. Can I go ahead?
Please go ahead.
Sir, I noticed that step 5, tax paid on interest saved. From the question, they said our tax should be paid in arrears. Is that why we are starting from year 2 to 4?
Yes.
That means in the first year, we are not going to pay.
Yes, you pay it in year 2. Yes.
Thank you.
You're welcome, sir. Thank you. So we need to 11. Wow. Okay, a quick one. Can I give you this as assignment? Just put it in this table because most of us, right, will go to work tomorrow, right? And then I don't need to come back to it. You just need to put it in this table. So you discount it with the commercial rate. What is the commercial rate? Class.
5%.
Commercial rate. %5. That will be your this year. So can you complete this question? Just bring all what we did here from all these steps here. All right.
Yes, sir.
Insert it here. Get your PV of financing effect. When you get your PV of financing effect, then you will now say adjusted present value, base case plus the PV or subtract PV of financing effect. You have your adjusted present value. Then you can now advise if they should go ahead with the projects. Class, I hope I've been able to explain adjusted present value to the best of my knowledge, actually, because I believe that you can solve adjusted present value. So you just have to go over it again. It is not a rocket science. I just have the privilege to take SFM. Many of you can even take it better than this. Yes, I only have the privilege. So I believe you can. So please go over it again. Then in our next class, we'll solve another comprehensive question adopted from ACCA. And please, before our next class, Saturday, when you go over this question, you can check past question. Similar question like this is also in the past question. You can check and solve. Try it again, right? So I believe you can. So in our next class, we'll solve a comprehensive question on another comprehensive question on adjusted present value. So,
Sir, please, I have a
I think
question.
we have
Just a quick one, please, sir. Please, sir, before we go.
go
Hello,
ahead,
sir.
please.
Okay. Please, I'm still
Please go ahead.
confused on this. I'm still confused on this equity that you charge issue costs, because I thought equity is just within the company. They don't need to go and borrow or
But
anything.
they give, you don't borrow equity.
No, I thought it's
Madam.
within the company, sir. I thought
No,
it's
it's
debt
not within
that
the,
has
no,
issue costs.
no. See, madam, the equity didn't recently now that some banks are going to source for finance. Is that not so? Is it not going to cost them? It will cost them now. That is right issue. That is equity. But it was stated in the question that we just follow the question. The question says there is issue cost on equity.
Okay, sir.
Did you see any interest on equity? No interest, because equity holder, they are not interested in the interest. What they are interested in is the return on their investment. So it is not within the company. They have to sort. The only thing that is within the company is retained earning. If they want to use retained earning to source for the finance, you should not equally forget that under the method of financing, we have what we call the static order, the pecking order theory, whereby when they want to finance the project, they will look at the retained earning. And if retained earning is not enough, they will go by debt. When debt is not enough, they will go by equity. They have to how will they now source for the finance using equity? Is through right issue, or what we call public offer. Do you get?
Yes, sir. Thank you, sir.
I don't tire.
Yes, sir,
So we
we
need to
don't
go.
tire.
Good evening, sir. I have a question.
Oh, okay.
Just
Okay, I'm tired though, honestly.
for
Okay.
that issue course, I also want to know that 1%. Why was it divided by 99 and 3/97?
Yeah.
I thought it should be 1/100.
No, it's not, because we have to gross it up to arrive at our gross amount. So it is assumed that the 150 million you have is the net amount. So if you have the net amount, you need to remove the element of the issue costs. Excuse me. So that is why it is usually 1/90. When you have 1%, when you have 3%, 3/97. So we need to go away. So any other question? Any other question, please? I need to check on. I need to check on Bashirat. Aisha, are you still with us? Ajuwon, are you still with us? Ayomide. Esther.
Yes, sir.
Okay. Madam Victoria. Rachel. Okay. So thank you so much, everyone, for joining, and enjoy the rest of your evening.
Thank you, sir.
Ready. So please, our Saturday class will start at 11 a.m. and I will communicate that in the platform. So thank you so much, everyone, for joining, and have a wonderful night, guys. Thank you. Bye for now.
All right, thank you.
Thank you. Thank you.
Good night, sir.
Good night.